Hello, everyone. Glad to have you watching in our little 10 to 15 minute production here in regards to Biden's tax plan. My name is Gennaro Carteropoli. I am the CPA and president of Hortonist CPAs. And a little about me, I'll explain a little bit, but to give you a bit of background of why I'm doing this is we've had a lot of questions in regards to what to do now that it's become clearer and clearer over time that Biden is likely to become the next president of the United States. And he has ambitious ideas in regards how tax reform should look like under his presidency. However, the common theme you might see is that it may not be as dangerous or scary as it's made out to be. However, each case is different. We'll discuss a little bit about that towards the end. So to give you a background of why you should listen here today, to identify key provisions, key provisions, I should say, of Biden's tax plan, determine who it impact, and getting a closer of understanding of should you really have a call to action at this point. Keep in mind that moving money or strategizing can oftentimes cost money, just like similar to buying and selling stocks because of the fear of how the market's going to do also can cost you money, as well as opportunity costs. So first off, let me give a bit of background about myself. I'm the president of Horton CPAs, Gennaro Carteropoli. I have 11 years of experience, and I worked at large public accounting firm Grant Thornton, which focused a lot in tax planning, leadership, and a lot of it there I worked at was a lot of times in manufacturing, construction, and in essence some international issues as well. But we also did tax planning oftentimes and tax returns for executives. I worked as a lead tax researcher as well at the National Association of Tax Professionals. So tax is an extreme strong point, I would say, of mine, considering what my prior resume entails. Not very many people go into the tax research arena, and I'm the current president of Hortonist CPAs, and where we have a team of a total of 5 CPAs, ranging from individual taxes, trust estates, to businesses and tax planning and consulting. So Biden is now projected as president-elect and to be president. Now, keep in mind, there are still pending challenges. Having said that, between court cases and where some people speculate off of faithless electors, nonetheless, it looks like it's projected that Biden will be the president of 2021. And he has promised tax changes, or more so tax increases. That is certain. But remember Government 101, that in order to pass such a sweeping legislation, you have to have the House, the Senate, and the President approve the same bill or to turn it into law. So if one of those three, there's not enough votes to pass the bill, it's going to stall. So first off, before getting into that arena, first let's touch on what does this plan entail. The overall promise that Biden provides is that under $400,000, you're not going to see a tax increase. Now, having said that, the question I get from many clients is, well, is that true? And to the many extents, it can be. However, there are, of course, a few gotchas or things that haven't really been identified that, as of right now, can very well cause increases of taxes into the middle class. So some details of some key provisions. Biden proposes increasing the Social Security tax for earnings over $400,000, increasing the TOPS tax rate to 39.6%, as well as converting long-term capital gains and qualified dividends to ordinary income of over $1 million of income. For those that are unaware, capital gains, mainly long-term capital gains and qualified dividends, provide a preferential tax treatment. Gets a lower tax rating, or tax rate, I should say. So the idea is to take that key break away for those with over $1 million of income. It expands the earned income credit, which is targeted towards lower income taxpayers and some lower middle class taxpayers, increases the dependent care benefits from $3,000 to $8,000 a child, or up to $16,000. For those with kids and daycare, you very well know that the $5,000 of FSA money or $6,000 allocable to a credit pales in comparison to the cost that it takes to have daycare. So this is probably more in line with what it takes to have a children in daycare, as it is effectively a direct cost to made in order to be able to work for many parents in real life. It increases the child tax credit. It brings back the first-time homebuyer credit, which I personally find a little interesting because that was utilized in 2008, 9, et cetera, to inject more money to get people to buy houses and keep the real estate market alive and well. So I thought that was interesting that, that his idea was to bring that back, as well as restores the gift death tax rates down to pre-2009 levels. Right now, effectively, you can pass or die with over almost $12 million worth of net assets and without a tax increase or tax to your death or inheritance. But pre-2009 is only maybe a couple million at best. So while that's still a fair amount, and a couple million, that is a drastic decrease, as a lot of people more towards the middle class can start being impacted by that, because between their house and 401k, there are a fair amount of retired individuals who can come close to hitting that death tax arena. As well as keep in mind that farmers of Wisconsin can also be impacted by this, because oftentimes farmers, they're sitting on one of the most valuable yet illiquid assets, and that's their land, and can oftentimes well exceed $10 million. So there are some logistical issues that can very well hurt in that sense some middle class taxpayers just in that arena alone. They expand the Affordable Care Act credits and expanding the IRA benefits. And the back on track. Now, of course, there's a fly in the ointment here with this. And this is where the rubber really starts to hit the road, where I start noting that there very well can be tax increases to the middle class. So I already talked a little bit about the death tax, but then there's also, and this is a big one in my opinion, is the repeal of the step up in basis. The step up in basis, I'll give an example in a little bit, but it really impacts inheritances significantly and can drive a lot of potential tax planning in that arena. And there's no discussion in regards to the Tax Cuts and Jobs Act, or TCJA, after 2025. I have a slide for that in just a little bit. The step up in basis being one of the biggest things I want to discuss here is that, to give an example here, effectively what it does is upon death, your gains or your tax that you would pay on selling assets of someone that passed away is effectively forgiven. Take, for example, let's say you have an Uncle Steve. I know everyone has an uncle somewhere, and this uncle, he's in Wisconsin, so of course he has a cabin up north. He has a cabin for 50 grand and it's worth 200,000. It's a good chunk of change, nothing extravagant, but still something worth something nice. So now he dies and leaves you the cabin. Under the old rule, if you would be able to sell it and cash in $200,000 without tax repercussions, that's called the step up, because had Steve sold it during life, Uncle Steve, he would have had to pay tax on $150,000. That's that 200,000 minus 50,000, which Steve paid for it. That's his profit. So you inherit it, and the old rules is that, or under what's always been prior to even President Trump's regime, or Tax Cuts and Jobs Act, I should say, you would pay no tax upon the sale of that after death. However, under the new rule, which repeals this step up in basis from going from 50,000 to 200,000 to determine the profit, you would end up paying tax on that sale. So assuming a 20% tax rate, which isn't far-fetched, long-term capital gains plus the state of Wisconsin tax, you're effectively now paying $30,000 of tax on an inherited cabin you would have otherwise never paid prior to Biden's tax plan. That is, in my opinion, probably the biggest significant change to the middle class that's pending. Now, keep in mind, details aren't released on that, and if he's going to exempt people under a certain threshold, but as it stands, just based on purely what was stated, that is probably the biggest risk to the middle class, in which I would, if I were to be convinced on anything in regards to tax planning for those under 400,000, this would potentially be it, but hold the phone until a couple slides more. The next thing was the Tax Cuts and Jobs Act, which was enacted under President Trump. Most taxpayers saw a tax decrease, and when enacted, Republicans did schedule these tax decreases to expire after 2025. So having said that, Biden doesn't present any argument or statement as to keep it, to get rid of it, to let it lapse. But having said that, in all fairness, his presidency would go through 2024, so that's kind of a second-term dilemma, if you will. So having said that, I can't necessarily blame him for not touching on that, but because that's more than one term away. So we'll have to cross that bridge when we get there. So, but as it is scheduled, after 2025, most taxpayers' taxes for individuals are slated to increase after 2025. Now, not to mention, like I said, it's moot if reelected, unless he's reelected in 2024. We'll cross that path when we get there. Now, circle back and think about Government 101. All this tax planning comes really down into the hands of Georgia. And why Georgia? Well, Georgia has this special runoff election here. And this runoff in January will determine who controls the Senate in for the November 3rd election. So the Senate, if it's Republican controlled, you can bet you that it's unlikely that any sweeping reform or tax increases like this will pass, because they would not have, the Democrats and Biden would not have enough votes to pass any sort of bill. Now, of course, there always could be some sort of slight tax change, usually stapled to the back of some trading bill or some baloney like that. That's usually how it works. They always sneak in, a few off the wall tax changes along with a lot of bills that pass, but I digress. So, but if the Democrats do at least tie the Senate, then with the vice president acting as the tiebreaker, they would in fact have the power and the votes to pass a tax reform. So right now, we really can't say for sure, but as it stands, it is projected that the Senate will be controlled by Republicans. We'll see, we'll find out more in January, but that is what it's seemingly projecting to be. Now, having said that, even if the Democrats were to tap into it right now, I still wouldn't recommend making any sudden knee-jerk reactions, because I still find it personally unlikely that that tax changes will happen immediately. A reason being is, first off, like having, I've watched a lot of ASCPA webinars, webinars or webcasts by large public accounting firms that are more in touch with Washington. I can't say, of course, I don't have a red phone sitting next to my desk where I can call up the president and say, hey, what are you thinking? But tongue-in-cheek remarks aside, consider this. COVID-19 still remains a priority. It's not going anywhere anytime soon. So any bills or efforts or expended by Congress are most likely going to be targeted towards COVID-19 and what it's doing to the economy. And even some key Democrats have signaled that that tax increases should wait until the economy recovers, which makes a lot of sense. Typically, it's very poor policy, even for the left or for Democrats, increase taxes during a time of turmoil on the economy. Usually you want to cut taxes or increase spending in recessions or when the economy is fragile in order to keep it going as a general economic policy. But for in this case, having impacting here, so even some of them would potentially shy away for supporting that in the meantime. Now, retroactive tax changes, in addition, are also rare. Most of the times when a tax law is passed, it's usually prospective, meaning they pass it, let's say in 2021, it's effective for 2022 and forward. The same happened for the Tax Cuts and Jobs Act, TCJA, passed, signed by President Trump, was that they passed it in 2017, but it didn't take effect until the 2018 tax returns filed in 2019. So it took over a year before Americans actually felt something in regards to the tax reform. So so keep that in mind. Now, while it's not possible, there's always a few provisions that are retroactive. Most would likely be
prospective. So that gives us enough time to plan for most reasonable outcomes. Because remember, as a CPA, I base everything off of reasonable expectations. I don't give in to what what news opinions are out there, because you have to look at the motions by Congress and read the fine print to really get a true understanding of what the intents and what's going to happen in the near future. Do not cave in to speculation, conjecture, and fear. That costs money. Each person is different. I mean, I can't put a price on what it takes to sleep good at night. So I mean, there's one thing that sleeping well at night, that's priceless, but I can't say that most people think about taxes when drifting off to sleep. So I would always recommend a consult before moving forward. To get an example, one thing that hypothetically could combat the loss and step up in basis, for example, could potentially be something called deferred sales trust. It's an advanced tax technique to control of when you recognize the gains. So you could almost cut down the tax in more than half by doing this mechanism. But setting up a trust like that can cost anywhere between $5,000 to $10,000. It's an expensive maneuver. So you have to balance the pros and cons of making such a move, because right now, as it stands, there is no slated tax increase until further notice. So I wouldn't recommend just plowing through and making a bunch of moves with money, because making moves with money typically costs money. Now, that's not to say you should completely ignore this, but so if there are some simple things that can be done, for example, whenever you're concerned that taxes are going to increase in the future, a common technique is to speed up income if you're a business, to invoice earlier, get paid earlier, to input the income in the lower tax rate years. But I wouldn't recommend that if that shoves you into a higher tax bracket. So, because then it's a cut your nose, spite your face. Essentially, if, I'm one that I've always liked to play Texas Hold'em poker once in a while. Right now, it's going in, it's pushing a lot of chips in before you even see any cards hit the flop or see the flop or anything like that, which means that you're making a decision with a lot of incomplete information at this point. So I certainly don't recommend making any knee-jerk reactions, to talk about it first. As CPAs, our job is to be that coach, that voice of reason, that advice and counsel in regards to that. Well, of course, we can't predict the future. I can't predict what happens in the Senate, nor can I predict if they decide to change their mind and instead of focusing on COVID, focus on tax increases. The prospects seems to be very unlikely. So having said that, I hope that gives you a little bit of clarity on some of the details that's been put out there. And these details that I put forth have been verified by several sources. So having said that, I hope this gives you a little bit of guidance as to some of the details in regards to Biden's tax plan, and it's like arms you with a little bit more knowledge in regards to this subject. So as a CPA, I believe in that it's ultimately your money, your decisions, but you should be armed with the most reasonable and good information before making those decisions. So you're making decisions based off of good information. And I hope I was able to present some of that to you. If you have any questions, feel free to reach out to us. You can email me here or give us a call at the office number there below, 920-725-1040. Thank you very much and have a great day.